Hey guys, welcome back. Today we're going to talk about four sectors or four groups of industries that typically do well when interest rates go down. I think we should keep an eye on this because although we don't know when interest rates will go down, it could be 18 months for all we know, we do know that they will probably go down. By how much? Again, don't know, but they will probably go down. So, a couple of areas that should take consideration for this because they tend to do well as interest rates go down. One is the consumer discretionary zone. So cars, appliances, specialty items, luxury goods, and leisure goods. People who produce that, you can think, Louis Vuitton, which is fairly expensive right now anyway, but they don't just have the bags, right? They own all sorts of stuff, including alcohol, distilleries, and you name it. So as a luxury goods provider, when interest rates go down, typically people have a little bit more discretionary spending and they treat themselves. They'll buy luxury goods. So that's an idea. Louis Vuitton is not a recommendation in this case, but an example. The second sector, before I move on, during periods of interest rates decreasing, the consumer discretionary sector has about 75% chance of beating the market. Basically, 3 out of 4 chances of doing better than the average. The next sector that typically does well is technology. Now, in this case, for my part, the NASDAQ 100, which is heavily tech loaded, is pretty much at its all-time high, and it did beat a record not too long ago. It hasn't come down that much from there. I don't know that I would really dabble in that one, but it is true that during periods of low or lowering interests, technology sector does well. Typically, 66% chance of doing better than the average market. Next to that, third one is real estate. So right now, interestingly enough, the real estate index, I can't remember its name, anyway, it escapes me. It's actually quite low. It's matching 2014 pricing. So real estate, because of high interest, because of the anticipation of mortgage defaults and all of that risk, which has turned into negative speculations, has kind of pushed the price down. I'm not saying it's going to necessarily explode, but I do expect that we are in a situation where the elastic has been pulled back. People are holding their cash, holding their down payment, waiting for interest rates to start going down before they launch into trying to negotiate mortgages and enter the buying market, which will create pressure and force prices up as people start to compete, and that will create opportunities in the real estate market. So if you're looking at real estate investment trusts, commonly known as REITs, you have a good chance of making money. In historical cases, 62% chance of beating the market average during a period of interest decline. And the last one, this one's counterintuitive. It's the financial sector. And you would think, well, banks make money from lending money for the most part, so for them, interest rates going up is good. And it is, to a point, because eventually it starts creating pressure both on the people who have outstanding loans that may get pushed towards defaulting or insolvency. And it also forces new loan takers, or prevents new loan takers from applying and taking loans. So their growth has a spike, but then kind of plateaus and is at risk of going down. So what'll happen, presumably, is right as the interest goes down by 25 basis points or whatever they're going to do up next, you can expect everybody to take a deep breath in the financial sector and think, cool, the risk to the banks is mitigated or going down, so the bank stocks will start to go up as more and more people want to buy them. And another interesting thing, so the index is for Bank 100, I can't remember again what it's called, sorry about that, is roughly matching 2021 levels right now. So it peaked quite a bit just before and then has come back down. So, gives an idea of how high or how greedy it might be. And in this particular sector, you'd have a 52% chance historically of beating the market when interest rates are going down. So there you have it. A couple of market segments to look at. You still need to, filter your companies and choose good quality stocks. But if you look at these four, as we're poised to see interest rates go down, I think you're going to find some good winners. And yeah, thanks for watching. Please subscribe.